Good afternoon, and thank you very much for this invitation. I'm very pleased to be representing the Center for Global Development and the report that we have produced on financial regulation for improving financial inclusion. I was listening a little bit of the last presentation, and I can see the importance that this discussion, this meeting is giving actually to the issue of regulation. We are aware, very aware, that there are many constraints for financial inclusion, and that one of those is financial regulation. And the focus, actually, of the Center for Global Development report is on financial regulation. And why is that? Because, as the previous presenter have made it clear, there is no way that any activity in the financial system actually takes place without a regulation that enables it. So with the recent development of so many technologies and innovations, well, to be able to adopt and adapt those innovations, regulation is needed. Also, at the same time, financial regulators face a constraint. The constraint is that usually they have traditional mandates. Their traditional mandates are financial stability, the integrity of the financial system, and consumer protection. So if we want to add financial stability into the menu that the regulators would like to implement, what are the best practices? To answer this question, what we did is we thought of a framework of analysis that basically is based on three principles. Those three principles form the base through which we produce a number of recommendations for financial inclusion. So let me tell you about the three very basic principles. The first one is that if you are going to regulate the financial system, similar regulations should be applied for similar functions. This is known as the functionality approach, very well known by the financial regulators, and that's why we believe that they will be very comfortable with this approach as when it's applied to financial inclusion, and I will explain how this works in a minute. The second principle is that regulations needs to be based on risk. Riskier the activity, the more burdensome the regulation. And the third one is one characteristic that is not so much used in the financial sector, but is used in many other sectors, and is balancing between ex-ante and ex-post regulations. Ex-ante regulations is what everybody in the financial sector is very accustomed to, and is a set of rules that are, as I just said, set before an activity or company starts its production, its offering of services. Ex-post regulation is when the regulator notices or discovers some inappropriate behavior, it reserves to itself the right to modify certain regulations. I'm going to explain that too. So with those three principles, very basic principles, we propose three sets of recommendations in three areas: competition policies, on the area of level the playing field, and on the area of know your customer. Let me first move to competition policies. I think there is no argument or no dispute about the importance of competition policy for financial inclusion, since, as we know, the more players, and secure players, of course, that provide services in the financial sector, the more likely that they are going to be expanding the services to those that have no access at the current times. But also, the more producers and offers of those services, that means that there is going to be more efforts to identify the needs of the underserved. So competition actually promotes innovation. So what is the goal of competition policy? To allow and encourage the entry of new and qualified. Qualified needs to be underlined, providers of financial services. So let me give you an example to illustrate what I'm talking about. As you know, and it has been mentioned also in the conference, in the provision of financial services, there are many new players, and among them are, well, telecoms. You have the provision of all type of networks that includes also ATMs in the banking sector. Well, those networks need to interoperate, needs to be connected. That's ideally what one wants to achieve. One would like the consumer not to depend on a single network, but to be able to make a payment, make a transfer using one network, and that a receiver in another network would actually be able to receive the funds with no problem. However, when you're going to regulate interoperability, a major question appears. Should it be mandated? Should it be compulsory for regulators to impose interoperability? And the answer that we have is no. The desirable path for regulators is to actually encourage that interoperability emerge as a market solution as opposed to be imposed since the very beginning. If you follow that kind of tree that you have in the PowerPoint, basically this is the way it should work. Well, the question is, does interoperability emerge spontaneously in a market? If the answer is yes, well, of course, the regulator relaxes, there's no more to do. But if the answer is no, then what is the role of the regulator at that time? Apologies, it moved. Just 1 second. Okay. What is the role of the regulator if interoperability is not emerging? Well, the role of the regulator at that time is to deal with those market distortions that are actually preventing interoperability to emerge. The most typical example is monopolies that get entrenched into the field of the provision of the services, basically controls the network and does not want to share the network with other providers. So the problem then is the behavior of the agents in the market, and antitrust rules, modification of those rules, or perhaps enhancement of those rules is what is called for. Now, if after correcting for those deficiencies, interoperability does not emerge, well, then is the time for the regulator to start asking the question, is it now the right time to mandate interoperability? As a last resort it is, but being careful not to intervene neither too early nor too late. Intervening too early could actually prevent or constrain the innovative forces in the market. Why I'm saying that? Because when we are talking about financial inclusion using the new technology and the new innovations, we need to remember that it is new. These processes are new. They are emerging in some countries, in some others have developed, but in the majority of countries, in developing countries, it's still very new. So you need to give time to the market to develop. However, if you wait for too long, then the problem is that entrenched monopolies could be too difficult to actually allow for competition. Let me give you an actual example of how interoperability have actually taken place or improved in two countries. Let me compare for you Tanzania and Kenya. In Tanzania, the goal of the regulator was not to intervene, was to encourage interoperability, but without direct intervention. So what happened is that the IFC, the International Finance Corporation, which is part of the World Bank Group, basically facilitated an industry-wide process of cooperation between the providers of financial services through mobile network operators. So the mobile network operators, each one had their own network, and there was no interoperability. The IFC came as an honest broker and helped the coordination and discussion between these mobile network operators in such a way that by 2014, the providers, basically Airtel, Tigo, and Santel, agreed to interoperate, to interconnect their networks. The dominant player there was Vodacom, and Vodacom joined in 2016 and agreed also to join the network. So this was a guided, encouraged, but market-led solution for interoperability between mobile network operators that were providing financial services in Tanzania. Now, let's look at the example of Kenya. In Kenya, the major providers, the major mobile network operators that work with banks in the provision of financial services are not interoperable. However, a big problem there is not only that the whole systems are not interoperable, but that the agents serving each of the networks also do not interoperate, at least until recent times. So let me explain what happened. So there was what is called exclusivity in agents. M-Pesa, as you know, is the most important system provided by Safaricom, which is the major player. And the Safaricom was not sharing its network services to other operators. Instead, the government, what they did, and actually it was the Competition Authority of Kenya, decided that the market had evolved sufficiently and that there should be interoperability. So they got to the stage where they wanted to mandate interoperability among the agents. But the only thing they did, it was to announce that interoperability was going to be mandated. The moment that announcement took place, Safaricom opened its M-Pesa networks to the other players. So this was again an inducement in interoperability as opposed as an actual law that mandated interoperability. What about leveling the playing field? Remember I talked about that we're working on 3 areas, and I'm just providing some examples. The report that I hope that you all have, we sent a number of copies, have details on the 26 recommendations that we advanced. Again, I said that we are dealing with competition policy, and the second one is level the playing field. The last one will be know your customer. On level the playing field, well, when you have a system, a sector, like the financial sector where there are so many players, where digital financial services is now booming in terms of not only players, but innovations, business models, where certainly you need to have regulations that do not favor one provider versus the other, or put it another way around, that do not discriminate against one provider versus another. And so leveling the playing field is essential for financial inclusion. There are so many regulators, there are so many actors, that is not always that easy to think about what are the regulations that are actually going to level the playing field. So the goal is, in the same way that in competition, I was talking about the behavior of agents. You don't want the entrenchments of monopolies to develop. You actually want to promote the entry of new players. Well, in level the playing field recommendations, we focus on the actions of regulations. So the goal of leveling the playing field is that to prevent that regulations create distortions, even if unintentionally, favoring one type of providers versus another. Let me give you an example. In Indonesia, for example, the level playing field is kind of distorted for the provision of financial services using mobile phones. Why I'm saying that? Because mom and pop shops, small providers, little retailers, very small retailers, cannot act as agents unless they work only with large banks. So, if you're a small bank, you cannot use mom and pop shops as your agent. Only if you are large banks, you are allowed to do so. And to us, that is a problem. You are not leveling the playing field. You are not allowing the actual development of the market because many small banks, as long as they are sound, solid, safe, there is no reason why they should not take advantage of this large network of mom and pop shops. So to give you an idea of how we have formulated our recommendations in the area of level the playing field, the idea is the following. If you have the same product, then it doesn't matter who are you as a provider, you should be regulated the same. That is the functional approach to regulation. However, we add something that is very important. That will be correct as long as the risk is the same. So you can be providing one service that is identical, but if there are characteristics in the provision of that services that imply different amount of risk, then the regulation should be adjusted accordingly. Let me give you an example. Think of India. India has a new model, the so-called payments banks. The payment banks are new institutions. They are banks. They are regulated banks, but they have a specific characteristic. On the deposit side, they only accept very small deposits. But most interestingly, on the asset side of the bank, the banks cannot take risks. The only thing they can hold is very secure assets, specifically government paper and highly liquid assets. What does this mean? This means that the depositor does not have to fear that it's going to lose its funds at any moment in time because are totally secured. Okay, what is the payment banks offering as a financial instrument for financial inclusion is a deposit. Now, compare that deposit with another deposit from a regular bank. In a regular bank, the asset side is not just government paper, it's leverage, loans, credit. There is more risk involved in the provision of credit. So, the service is the same, a deposit. Deposit by payment banks or deposit by regular banks. The service is the same. Should the regulation be the same because I'm talking about two identical products? The answer is no, because in one case, the payment bank is offering a deposit that is a very safe deposit, while in the case of regular banks, they are subject to the leverage of the balance sheet of that bank. And therefore, being regular banks, they need higher amount of regulation in comparison to a payments bank. This happened for many examples. You don't have to use, I use India, just came back from India actually a couple of days ago, and so it helps me well for the example. But the truth is that you can think of perhaps electronic wallet as opposed to payment bank, just electronic wallet versus a bank deposit, and many products like that. The bottom line is that what is shown in this graph is the higher the complexity and the higher the risk involved in the provision of financial services, the more the regulatory burden that should be imposed in the provision of that service. What is the product that is the safest of all among financial services? Payments. Think of Western Union. An individual goes, leave their funds there, and the only risk that is happening for those funds is the intraday, the settlement of the transfer, the risk between sending and receiving the transfer. That's the only risk involved. However, if you move to providers of store of value services, meaning that involve savings or involve leaving your deposits in a given agent, could be a bank, could be an MNO, mobile network operator, or other kind of digital providers, then risk starts increasing, and at the top of the graph, you see the provision of credit services, which implies more leverage and therefore more risk, and therefore an increase in regulatory burden. Finally, on the set of our recommendations on know your customer. Okay, know your customer have these dual advantage and disadvantage roles. On the other hand, it's clear that the better providers know their customers, the more willing they're going to be to offer a more variety of financial services. At the same time, and that I'm sure has been discussed in this conference, excessive know your customer requirements could actually hamper financial inclusion, as providers could be find too onerous to serve um, uh, uh, customers that are poor. Why? Because they're the riskier, right? So the goal is to design know your customer rules that actually deal with both objectives. The objectives of financial integrity, which is the reason why we have know your customer, and the objective of financial inclusion. So to represent this in a graph again, know your customers have to be designed to meet two objectives. One, achieve financial integrity, defined against money laundering and terrorism finance. But at the same time, they should actually support financial inclusion. How do we do this? Well, internationally, the risk-based approach has been accepted as the way to go. You know, the riskier the consumer, the higher the burden on know your customer. But the problem here is not the problem of design of regulation. The problem is actually a problem of implementation. You know, there is in the world these days a very unclear definition of what is too much risk and what is real financial integrity. To say that we are going to only accept zero tolerance for money laundering might not work in the world. There's always going to be theft, there's always going to be fraud in the system, and therefore, just to say, okay, we're going to have only zero tolerance might actually be burdensome. So what we are basically proposing is two things. The first one is any solution to the problem of know your customer needs to be based on a strong national ID, basically confined or based on biometrics. Without strong national IDs, it's going to be extremely difficult to have effective know your customer rules that actually benefit the poor. The system of Aadhaar in India is actually a good example. At the same time, and some countries are moving in this direction, less onerous know your customer rules should be implemented for very basic accounts for low-income customers. And there's also examples in the world about this. And finally, and with this I can finish, is the proposal that everybody thinks it's a great proposal, but no country has applied, which is called graduated penalties. Graduated penalties basically means that if a financial institution faces a case of money laundering, for example, but has been following all the due diligences that are asked by the regulators, the penalty should be small because it has complied with due diligence. Now, if it becomes a serial killer, a serial offender, then of course the amount of penalty should be increasing. So it is a graduation of the penalty that would clarify to the provider what is not compliance with Know Your Customer regulations. Okay, so to finalize, getting financial inclusion in the world for all the reasons that have been explained in this conference is a very desirable goal. However, when you are going to implement, design, think, and propose regulation for financial inclusion, it is essential to keep in mind that financial inclusion is only one component of the 4 mandates that actually financial regulators have in mind when designing regulations. They are interested in financial stability, financial integrity, and financial and consumer protection. So to add financial inclusion, you need to be sure that the recommendations are aligned across the 4 objectives. The recommendations in our report do exactly that. Thank you for your time.
Thank you very much, Liliana, for your very elaborate and illustrative presentation. I hope you will be around towards the end of when the 2 speakers have presented theirs. You will probably be expected to answer or comment on some questions from the floor.
Okay.
Now,
thank you.
Okay. Now I turn to Ms. Ashley Hope to take the floor, please. You have your 15 minutes.
Thank you, Chair, and thank you, UNCTAD, for giving me the opportunity to speak to you a little bit today about financial sector regulation and trade in Africa. When I was asked to talk about experiences in Africa in promoting coherence in trade and regulation in the financial sector, I immediately thought of the SADC Integrated Regional Settlement System. And if you're here yesterday, you'll know that this is the example Vahini used. It's a good example. I hope it means it's not the only example. I won't go through it again today, but I wanted to touch on some of the factors that perhaps made this a success compared with another cross-border cooperation project in the financial services space in Southern Africa. This other project is the Yellow Card, a cross-border personal liability insurance product that's been operational in Eastern Africa for many years, but has failed to be implemented in Southern Africa. My observation is that a couple of factors contributed to the lack of support for this product. There was no clear responsibility for taking the initiative forward. It was inconsistent with existing arrangements, meaning that significant change would need to occur. And there was not so much support for that change, either from the insurers, from the regulators, or from the potential consumers of the product. The settlement system, on the other hand, had a specific and measurable outcome. It was clearly beneficial to businesses, meaning the banks were committed to implementing this system. And even though its stalled at one point, its supporters persisted, and importantly, it was initiated and led by the central banks. So it's not the only lesson, but I think one key learning we can take from this is that having the right stakeholders involved from the very beginning, the regulators, those who are regulated, and those who stand to benefit from whatever the project is a good starting point for success when considering cooperation for the regulation of financial services. Of course, you can't ignore, in this case, the role of the big and powerful. A cynic would say that nothing happens in Southern Africa without South Africa's support. But of course, the reality is that in any negotiation, there will be power imbalances, and I think this makes it more important, as Alicia, I think, said yesterday, to carefully and strategically choose what to pursue and what not to pursue, to consider where and how support can be found, and to think about adjusting the incentives for the people and institutions from whom that support will come. So it's in this context that I will proceed with the rest of my discussion, which focuses on the place for financial services regulation in Africa's continental free trade negotiations, and a possible way, touching very much on what we've just been discussing, of helping to ensure that the right people are engaged in the process. As I'm sure you're aware, Africa has an ambitious agenda for a single continental market for goods and services. This is in pursuit of broader Pan-African objectives, boosting trade, enhancing competitiveness and supporting development outcomes. Of course, these are very relevant to the financial service sector objectives, and hence these negotiations offer an opportunity to have tough conversations about financial regulation, both in its role in trade and financial services, but also as an enabler of trade in other goods and services. But for this to be effective, I think it's critical to have the right kind of buy-in. And in the case of financial services, this very much means involving the regulators, not just to engage them in the trade negotiations, but to facilitate them thinking about how what they do impacts on trade. And of course, perhaps more than anywhere else in the world, when thinking about financial regulation and trade in Africa, it must be done with financial inclusion in mind. Inclusion that empowers economically, builds wealth, and fosters financial security. Achieving financial inclusion is an enormous task in Africa, but I think it's, as intra-African trade is being revisited with a renewed sense of purpose, it's a good opportunity to bring this discussion together. Africa has a population of more than 1 billion people, overall incomes are rising, fees for financial services are proportionally high, service quality and quantity is low. In the case of financial services, though, many African countries already have relatively open borders. So the environment should be ripe for disruption from foreign entrants. The promise of the benefits of financial sector liberalisation have not been met in Africa. So as we've been discussing yesterday, this is potentially because liberalisation commitments are really just the tip of the iceberg for delivering the benefits of trade and services. In terms of the continental discussions in Africa, financial services has been a priority sector in regional economic community negotiations. And given their centrality in integration and importance for economic development and trade, we can expect they'll be a priority in the Continental Agreement as well. As discussions on the shape of this agreement take place, negotiators and countries in Africa are carefully considering what place regulatory disciplines on financial services will have in this agreement. One option is that it doesn't have a place, and I don't think it's self-evident that trade agreements are the right place for discussions on financial regulation. There's international organisations for this purpose, there's bilateral engagement, and there's cooperation between regulators. The second option is that these negotiations really focus on regulation for financial services, because while potentially less controversial, the regulatory commitments are in some ways more important than incremental gains in access. Regulatory disciplines can provide a framework for greater integration and convergence of standards, as we've been talking about. The regulatory disciplines can drive regulatory change and improvements that not only improve conditions for business within countries, but make them more attractive to foreign investment. But I think there's dangers in including all of these commitments in a trade agreement if countries are not genuinely committed to the regulatory principles that they represent. Outcomes risk being ignored, either willfully because communication fails or just because they're another thing to get done in an already crowded agenda. And of course, as we heard from Sanya yesterday, there are some who consider that commitments in trade agreements undermine the policy space needed to pursue legitimate domestic policy measures. However, I think that discussions on financial sector regulation as part of Africa's continental negotiations offer an opportunity to reach a shared African understanding of what is necessary and appropriate policy space for regulation. The enthusiasm for continental integration presents an opportunity to do this at an Africa-wide level that might not occur again for some time. It will only work if the right people are in the room, if trade negotiators are supported by business leaders and regulators. It's not easy to do this, but I think of trade agreements that have a meaningful impact on regulation, it's essential. It's my view that trade people need to make a better case that the benefits will flow. Financial regulators, and I can say this because I have been one, only see downsides and risks to trade agreements. Financial regulators are always thinking, what if something goes wrong? How can we ensure our consumers, our system is protected and stable if the company is not within our reach? So there needs to be very strong incentives for regulators to engage and for trade negotiators to advocate for, seek and use their input in trade negotiations. Of course, the goal of trade negotiations is not to increase trade for trade's sake, but rather for increased prosperity. And it's increasingly acknowledged that shared benefits that improve people's lives are more economically powerful than those that accrue to a few. So I think we can say that financial inclusion matters to trade. As we've been discussing, it certainly matters to people who care about trade. So I think that the pursuit of financial inclusion can be a vehicle for bringing financial regulation together with trade in the African context. Discussions on trade can catalyse the engagement of trade ministries with financial regulators. This is important because regulation and regulatory integration risk at best being uncoordinated and at worst at cross purposes. Greater engagement of regulators in the trade negotiation process has an additional benefit of improving the comfort and knowledge of regulatory structure and capacity of other countries in the particular region, leading in time to greater likelihood of recognition or technical support. Even in Africa, where there's a well-developed system of regional economic communities, there's still a large set of countries who are simply not used to engaging with one another on trade and financial services. So I think that trade agreements are the right place for these kinds of regulatory commitments because they're powerful tools for cooperation, and the increasing prominence of mega-regionals has reinvigorated the role of trade in improving economic outcomes. In Africa, the CFTA is an enormously symbolic component of greater African integration and will become a critical touch point for governments. So I think if it's to be a true 21st century kind of agreement, incorporating these regulatory disciplines that we've been discussing over the past couple of days is important. And I think that the lens of financial inclusion offers one way to bring the right people into the discussions. Thank you.
Thank you, Ashley. Next, I call upon Mr. Andrew Conford to take the floor, please.
Well, it's a pleasure to be here for what must be my umpteenth MENA meeting. Now, Mr. Marchetti covered much of the material in the Panama-Argentina case, which has just gone through both dispute settlement and the appellate board. I did have some points a bit different from his, but nevertheless, I feel that in the interest of time, I'm not going to cover parts of my paper which have a significant overlap with his, but you'll have copies of my paper and you can look at it. I will be starting from fairly far on in the paper, and I'm going to be starting from the point that the findings of the appellate body in the case Panama versus Argentina, indicate the broad range of measures which, in the view of the appellate body, should fall within the purview of the Annex on Financial Services. However, the question of which policies, inconsistent with the GATS, the General Agreement on Trade and Services, can be justified under the prudential carve-out remains largely open. It'll have to be thrashed out by the dispute settlement body, this dispute settlement panel, or appellate body's rulings in future cases submitted for dispute settlement or in discussions in the WTO Committee on Financial Services. Now, issues in the debate over the applicability of GATS to the post-global financial crisis regulatory regimes, I shall illustrate this afternoon, for the issues of controls over capital movements and for possible inconsistencies between new regulatory rules and national treatment. Now, restrictions on capital movements in the GATS are covered primarily in Articles 11 and 12. Article 11.2 prohibits restrictions on capital transactions related to a country's commitments as to market access and national treatment. However, according to Article 12, this prohibition may be overridden by a country's need to undertake actions to safeguard the balance of payments in the event of serious external financial difficulties. Consultations concerning the need to take such actions are then to be based on statistical and other empirical findings of the IMF and on the fund's assessment of the country's external financial position. Now, the questions that I want to ask that relate here to whether GATS rules provide latitude for macro-prudential measures, that's to say measures that come under the heading of prudential but that are directed at the system as a whole rather than individual banks, for the macro-prudential measures which are an important part of the post-global financial crisis regulatory agenda. Now, under the heading of macro-prudential policy, capital controls are now envisaged as an appropriate response not only to classical balance of payments crises, where the policy challenge is the exhaustion of a country's foreign exchange reserves, but also to other threats to a country's financial stability. Now, unsurprisingly, since the beginning of the global financial crisis, official views of the relation between macro-prudential measures and capital controls have been extended. This is evident, for example, in an IMF document on capital flow management measures and macro-prudential measures. The IMF here acknowledges that there are situations where capital flow management measures and macro-prudential measures overlap. To quote the IMF, to the extent that capital flows are the source of systemic financial risks, which they have been in several recent financial crises, the tools used to address these risks can be seen as both capital flow measures and macro-prudential measures. An example could be when capital inflows into the banking system contribute to a boom in domestic credit and asset prices. A restriction on banks' foreign borrowing would aim to limit capital inflows, slow down domestic credit and asset price increases, and reduce banks' liquidity and exchange rate risks. In such cases, the measures could be considered as both capital flow management measures and macro-prudential measures. Now, the IMF now also accepts a temporary role for capital flow management measures on capital outflows for countries which face domestic or external shocks, which are large relative to the ability of either macroeconomic adjustment or financial sector policies on their own to handle. What remains to be seen is how far this new, more flexible view of situations where capital controls are an appropriate part of policy packages targeting financial stability is eventually translated into interpretation of GATS rules on capital controls and prudential measures, whether in particular the prudential carve-out can justify recourse to capital controls for reasons of avoiding financial instability. Now let me turn to the issue of national treatment. According to the prescription of national treatment in Article 17 of the GATS, in the sectors inscribed in its schedule of commitments, subject to any conditions and qualifications set out therein, I'm now quoting, each member shall accord to services and services suppliers of any other member, in respect of all measures affecting the supply of services, treatment no less favourable than it accords to its own like services and service suppliers. Now this seems clear enough. However, as regulation in the aftermath of the global financial crisis becomes more complex and the rules of regulatory regimes discriminate between different financial firms and transactions in pursuit of the objective of financial stability, strict adherence to the principle of national treatment may become difficult. A potential source of such difficulties are the special sectoral capital and liquidity requirements which several jurisdictions have also imposed or are expected to impose in addition to the standard capital and liquidity requirements of the Basel Capital Accords. Such special sectoral capital requirements may be applied to particular exposures such as mortgage lending, unsecured consumer credit, or particular categories of such credit, lending on commercial property, and lending to other parts of the financial sector. Special liquidity requirements may target either banks' assets or their liabilities or funding. Now, requirements to increase buffers of liquid assets during credit booms can provide banks with larger reserves which can be drawn down to meet margin calls or withdrawals of financing when the boom is followed by contraction. Moreover, supplementary liquidity requirements during booms can help to moderate cyclical increases in maturity mismatches by curbing credit expansion financed by volatile short-term funding. Now, in principle, all these rules can be framed to apply in a non-discriminatory way. That's to say, in a way that observes national treatment between domestic and foreign institutions. Nonetheless, their very complexity makes them potentially contentious and a potential vehicle for the provision of regulatory treatment perceived as favouring domestic over foreign financial institutions. Now, regulators' awareness of possible conflicts between efforts to reform global financial regulation and the liberalisation of trade in financial services is no secret, as are their reservations concerning the latter, that's to say the liberalisation of trade in financial services, when they're a source of such conflicts. Now, a member of the Board of Governors of the United States Federal Reserve System recently expressed such a caveat as follows: proposals to include prudential requirements, or more precisely, limitations on prudential requirements in trade agreements, would lead us further away from the aforementioned goal of emphasizing shared financial stability interests in favor of an approach to prudential matters informed principally by considerations of commercial advantage. The member of the Federal Reserve Board was Daniel Tarullo. Now, one can hope that awareness of such reticence among financial regulators will inform future interpretations of the GATS rules which overlap prudential regulation of finance. Thank you for your attention.
Thank you very much, Andrew. We have come to the end of the presenters' exercise, and now we want to open the floor, and we want to hear from you, because you have been listening to the podium. Now it is your turn for us to listen to. So the floor is open. Yeah. Now we start with Mr. Hofiko.
Thank you, Chair. First of all, let me take this opportunity to thank the expert of the panel of experts for those informative presentations. My question, actually, I have two questions, actually, on de-risking. Basically, what I wanted to find out, how this de-risking actually affect financial inclusions. In particular, the cross-border movement of trade in financial services. And secondly, how this actually risk avoidance, how effective is this risk avoidance compared to risk management? Thank you.
Thank you very much. Any further comments? Any further question? Sudan?
Thank you, Your Excellency, Mr. Chairman. At the outset, let me convey my compliments and thanks to all the distinguished panelists for their in-depth and resourceful presentations. In fact, I have a couple of questions of generally related nature, and as such, not addressed to a specific presenter. However, any presenter may respond to them. Question 1. As we all know, the GATS has classified the financial services in three subsectors, namely banking services, insurance, and capital market services. My question, is it advisable to have one single regulatory and supervisory agency over those three subsectors? And if so, what are the merits of that setting? And if there are demerits of that single regulatory body, I also would be pleased to hear from the presenters. Question 2. As we all aware, the financial services is considered one of the key infrastructure services, and equally, the telecom services is an infrastructure service for many other economic activities and for many other services, and in particular for the financial services itself. As such, in the context of that interlinkage between those two sectors, is there a specific congenial and suitable replicable regulatory and cooperative modalities and ways and means that can render the telecom services be financial services friendly and instrumental enabler, bearing in consideration the particular nature of the financial services, which many of them is susceptible to varieties of cross-border risks, that some of them usually be transmitted through mode 1 of the provision of that service, which normally effected through some of the telecom services. I thank you.
Thank you, the delegation from Sudan. Any other? Do you have? Do I see any flag? What, yeah, Cynthia, the floor is yours, please.
Okay, my question is to Mr. Missy Hope, related to the system, the financial system. Can you explain a little bit, if you understand, is the whole region? I mean, for the Africa in total, or you refer to the South Africa only? The difficulties you have in the system regulation, financial regulation. Thank you.
Thank you, Councillor. I take it that we don't have any flag up now. I think I can now come back here to the podium, but we shall start with those who are on the video conference. And if they have any comment to make, I will start with Liliana. Liliana, please, can you make your comment?
Yes. Yes, the risking is actually being absolutely taken very seriously among international regulators. The question is, what are the effects on developing country? And this is very much related to the know your customer rules that I've been mentioning to you in my presentation. Basically, what happens is that the stringent of know your customer rules for banks imply that they are not going to be providers to the riskier consumers. And many times the riskier customers are located in developing countries, in the poorest countries of the world. There's an extreme case that has been taken very seriously, and it's the case of Somalia, in which international transfers were basically cut off. And there have been proposals to try to solve this problem. One of them is called a safety corridor. in which some of the most credible customers actually qualify for transfers from banks in the advanced economy. But the issue of de-risking is actually significantly reducing the amount of transfers that many people in developing countries can receive, and therefore the effect is very negative. Very quickly, there was a question on the multiple regulators between telecoms and financial services industry and the need for cooperation. Well, this is extremely difficult to achieve, but it's my belief that it has to first start at the local level. And it has started in a number of countries through common platforms. Common platforms in which the different providers actually are providing one kind of product, and that product, by the definition of that product, is subject to one regulation to which the different regulators adhere. Let me stop here because of lack of time.
Thank you very much for your comments. Now I turn to Emil.
Yes.
Do you have anything to comment? Thank you.
Yes, thank you very much. Also on that first question on how does de-risking affect financial inclusion, I think the most direct way is what Liliana referred to, is through the de-risking of remittance companies, because there is that trope out there that says that each and every remittance company is ipso facto high risk. We do not believe that to be the case, but unfortunately that is the way that many banks' internal systems still treat remittance companies, and therefore if the volumes going through a certain remittance provider are not sufficient to justify the costs that are being made to conduct due diligence on that particular remittance provider, it will be cut off. And that in turn affects those people who are dependent on those remittance providers. Liliana referred to the example of Somalia, in which the World Bank has been very involved. What we did there eventually, and I alluded to that in my presentation, is we found a third party to supervise the remittance providers in Somalia, so that the remittance providers in the sending countries would have a degree of comfort as to the application of AML-CFT rules by those providers in Somalia. And we hope that that eventually will will provide necessary comfort, and therefore will keep the money flowing. I want to address one further point that the gentleman made right at the end of his question, to what extent risk avoidance was really effective, because I think that's a very pertinent question. And it is for that reason that it is precisely AML authorities that are so concerned about de-risking, because what is happening in certain countries is that you see funds that was flowing, first of all, through well-regulated channels, and therefore channels that were able to be monitored by financial intelligence units and others. Those flows move to far less transparent channels, i.e. they ultimately go in cash because no service provider is willing to effect those transactions anymore. So ultimately, why the individual service provider might believe that it is better off now that it has gotten rid of this particular risk, the system as a whole actually increases risk by pushing flows through less transparent channels. Thank you very much.
Thank you very much, Emil, and thank you very much, Liliana, for both your contribution. Now I'm kindly requesting you to turn down your microphone or turn it off, because it is affecting the operation interpretation here. But you can listen while the microphone is off. I come now to the high table here, and I will start with Mr. Andrew Conford. Do you have any comment to make? 2 minutes on the questions from the floor.
The question about the location in the government of the Financial Regulatory Agency, if I remember correctly. I think it came from Sudan. I don't think there's a general answer. I think it's country specific, the appropriate answer. I shall describe what happened briefly in Britain. An independent financial regulatory agency, independent of the Bank of England, was established by the incoming Labour government in 1997 because of a feeling that the Bank of England was too close to banks. And its report, for example, on the Barings case, showed a kind of inbred consciousness. The problem was that the same financial regulatory agency, or I should say group of financial regulatory agencies, were felt after the outbreak of the global financial crisis to have not performed well, to have been, again, too close to the financial sector. So the Conservative government, when it came in, decided that once again, financial regulation, not all of it, but most of it, should be transferred back to the Bank of England. I think, that gives you a sort of feel for the way in which such things happen. On the issue of de-risking, I have another little story. I remember after 9/11 talking to a member of the advisory committee with the Bank of England on the correct approach to take, and he told me there was a conflict inside the body over the issue of hawala, which is an informal system for making payments cross-border. Basically, there was an American who'd been both, I think, an FBI agent and an employee of the Federal Reserve who wanted a very, very tough policy. And there were many people on the committee who felt that that was misguided, because to the extent that you already knew something about the channels that were being used for hawala and probably other suspect payments as well, they were useful because they enabled you to keep a check on what was actually going on. Whereas if you introduced very much more stringent regulations, the payments in question would move into channels that you did not have any power of following, and that would be worse. And I think somebody already raised that question, that potential conflict in their question to us. That's my reply.
Thank you, Andrew. Ms. Hope, do you have anything? Comment? 2 minutes.
Thank you. Given the time, I'll just respond to the question directed to me. The system is currently operational in 9 Southern African countries. It started with 3 only as a sort of proof of concept, and in the next couple of weeks, it will be up to phase 5, and that will cover all of the countries in the Southern African Development Community. So that's where the system is operational, and it's a cross-border settlement system denominated in South African rand. But I can give you more detail if you want.
Thank you very much. Vijay, any comment? Vijay doesn't have any comment. I turn to my right. Ambassador Makuk, any comment?
Thank you. I don't have much to add on de-risking. Our statement was comprehensive, and the 2 interventions from the panelists by video have been very clear. I would say that the challenge is that de-risking is not so much risk management as risk avoidance. And the consequence of avoidance is that one columnist in the Jamaican newspaper described it as bludgeoning the policy. That is, instead of using the skills which are necessary for financial service operators, which is to measure and calculate risk and act proportionately, the de-risking mechanism is to withdraw completely. So it is not that you manage risk, it's that you seek to have no risk, which in the market economy is an unreasonable concept to privilege. I wouldn't go any further given the lack of time, but I think the details provided are sufficient. The consequences of the practice are well known. What we have not spelled out in detail is a consequential impact in the cost of doing business and the perception effect. If your jurisdiction is subject to de-risking, then immediately the consequence for investors is that the context in which business is done is compromised. And even if you maintain alternative channels or you restore the channels, the damage is done. Thank you.
Thank you, Ambassador Makuk. Now I call upon Mr. Joan Macheti. Please, you are last but not least, please.
Thank you very much. No, just a couple of comments on the question raised by the gentleman from Sudan on the appropriate regulatory structure. First comment, I don't think the GATS classification calls for any specific regulatory structure. So members can have single regulatory authorities or may have different regulatory authorities for different financial sectors and activities and still be able to make commitments under the GATT. So that's not the issue. However, let me add an additional twist to something that Andrew Comfort mentioned. Again, the appropriate regulatory structure is country specific, so it very much depends on countries' culture, organization, etc. There are pros and cons. The pros of having one regulatory authority, and that's why many countries do have one regulatory authority, is that following on what Mrs. Rojas Suarez said, it allows for better regulation on a functional basis. So you regulate, since many financial services providers do things, for instance, insurers give loans, and then you can also get some types of products in capital markets which have an insurance type of protection. Probably from a regulatory point of view, it makes sense to regulate them on a functional basis and therefore do it through a single regulatory authority. Now, the changes in the UK have not abolished that. That is to say, the UK still has the Prudential Regulatory Authority, which deals with banks, building societies, insurance companies, and investment firms. The difference is that instead of having that separately from the central bank, now they have it again within the central bank, but probably because this is also related to the ability of implement macroprudential regulation. So it is felt that probably with a single regulatory authority, such as the old Financial Services Authority in the UK, was not able to implement or have the full picture in case something happened as in 2008, 2009, because macroprudential instruments will be probably handled better by a central bank and not by a prudential regulatory authority that deals more with the soundness of individual institutions. So still you can have different type of regulatory structures and still, of course, coexist perfectly with any commitment in any trade agreement. So that's not the problem.
Thank you very much. Mr. Ofiku, you had your flag up a second time. Would you like to say something?
Yes, Chair. Just a small follow-up on that concept. De-risking. Don't you think is one of the obstacles to international trade, especially to the movement of trading services across the borders?
Thank you. Maybe I ask Ambassador Makuk to respond to that. And maybe Comfort will also want to say something later. Mr. Makuk, please.
Oh, thank you. That was the burden of our presentation to the Committee on Trade and Financial Services, because as was indicated by our colleague from the World Bank, when the issue is approached primarily in its financial and regulatory context as a response to counterterrorism and money laundering. In the case of its impact, it is not circumscribed to that, because correspondent banking is the conduit through which settlements are done, payments for goods and commerce. So if your traders cannot settle their trade bills through normal channels, the cost of the transactional costs are immediate. So it has a direct impact on trade. The ability to grow indigenous financial services, which primarily begin, for example, in money service businesses, cambios, traders, exchanges, which are, as the presentations have shown, the prime target for de-risking, means that your ability to grow your financial services sector is immediately impeded. So I think that there's no question that the consequence of de-risking for trade in financial services in and of itself, and the critical role that trade in financial services plays in all other trade. After 9/11, the discussion about trade finance and trade credit was largely related to the knock-on effect of what could have happened if these services were frozen. So I think that there's no question that this is a trade consequential effect, but it is being treated primarily from the financial regulatory forum. So we have to try to influence that discussion. We cannot take that discussion to Geneva, but Geneva has to affect the discussions in Washington. Thank you.
Thank you, Ambassador McCook. Emil, are you there? Emil?
Yes, I am there. Sorry.
Yes, you talked about the risking first when you presented your paper. Now, do you have give you 2 minutes to comment on it, according to the last question.
Yeah, yes, as Ambassador McCook was saying, we did find that indeed there was that was one of the clients highlighted by some of the local banks, that some of the clients they could no longer service were small and medium local exporters. So the provision of trade finance to those exporters was in danger as a result of de-risking. And you know, sometimes that is even preemptive. So I can't say that example for the trade side. I can give that example for the remittance side. We spoke to some banks who said smaller local, regional banks that depend upon relationships with large clearing institutions in the West and in Europe and the US specifically. And they said, well, rather than us being at risk of being cut off from our correspondent relationships, we preemptively closed the accounts of, in this particular case I have in mind, of 5 remittance companies that we were servicing, because we were worried that as soon as the correspondent bank came looking into our books and saw those remittance companies on our books, they would de-risk us. So preemptively, we decided to terminate them.
Thank you very much. Andrew, you want to say something?
What I have is much, much less systematic than the World Bank exercise. It just is that through reading The Banker and through talking to people, I've come to realize that access to correspondent banking services, particularly for poor countries, even before the de-risking became a kind of flag issue, was very uneven. It was often very, very difficult to set up a correspondent banking relationship. And my hunch, what it is that in the world in which we now live, where de-risking has become much, much more of a, to speak, policy issue, this inequality will have probably increased. I'm not sure whether the World Bank expert, who's obviously been exposed to much, much more systematic work on this subject, would agree with me, but that's my comment.
Thank you very much. I think we have come to the end of our discussions. I would like to thank all the panelists and the discussions for the wonderful job they have done in discussing the topic presented to them today. And I want to ask the audience to show appreciation for this presentation by our panelists, ably presented to us, by a round of applause. Liliana and Emil, and you, my colleagues here on the high table, I would like to thank you very much. Liliana and Emil, I want to thank you for your patience. You have kept with us, and that means you are committed fellows in matters of this nature. I wish you all the best.
Thank you very much.
Thank you
very much.
Bye now.
Now, for us here, we ask Mina to say something before I close the session.
Thank you very much, Chair. I just wanted to draw your attention to our evaluation form, which is in front of you on the desk, and encourage you to please fill up the evaluation forms because it's very important to our follow-up work and also for our evaluators. We would greatly appreciate if you fill it up, please. Thank you.
So with the remarks from Mina, we conclude the work of our afternoon session. We will resume work tomorrow morning at 10 a.m. I hope to see you there again. The session is closed.